Welcome everybody. We're going to be talking about advanced risk allocation. Just before we get started, and for those of you who don't know me, my name is Saul. I'm the senior analyst here at the 5ers Fund. Maybe at the end I'll give a few words about what we do, and this is only one of many resources we give to either the open public or to our traders. There's a lot of closed resources. So welcome, let's get started right now. Yes, this will be recorded, and yeah, thanks Alexander. I'll have the chat open for for some questions, but there's a large group, so I'll try to have an eye on that. So what are we going to do today? I'm gonna deep into three topics or three things that we need to discuss a little bit. So first, the risk management cliches. Okay, what we all know about risk management, what we all hear and study and see on YouTube and TikTok about how much you should be risking on a certain trade or a series of trades, and we'll discuss that as an introduction to go into the core of this webinar, which is the scaling in and scaling out of positions. And that will lead us to a risk allocation model, a triangle or a triangle risk allocation model. That this might be the new stuff for a lot of you. And then if we have time, we might go to the charts and maybe give some live examples. Just do know that I will be, or my expertise is on the Forex market. So if we go to the live charts, or if I use words, my vocabulary is, I will be using Forex terminology. But what I'm going to show you, you can apply it to stocks, you can apply it to commodities, you can apply it to Bitcoin, you can apply it to everything. Okay, so use these principles to your own trading and your own activities. So let's get into it. The cliches of risk management when we're trading. Most videos and educators and mentors, they teach you that you should either risk a fixed percentage of your account in a single trade, correct? A 0.5% or a 1% of your account in each trade, or maybe a 2% of your account in a single trade. Or if you're an aggressive trader, maybe you can trade 5% of your account on a single trade. And they explain you what are the advantages of doing this, correct? They explain you that if you stick to this fixed percentage of your account, eventually you compound your account and you grow faster and faster. And when you're on the losing side, sticking to a percentage protects you from losing larger amounts of money. So it has some good things when you're winning and good things when you're losing. Other educators will tell you that you shouldn't be risking a fixed amount of percentage. You should be risking a fixed amount of money. Okay, a dollar amount or a money amount. And they will give you examples and arguments of why is that the best thing to do, or advantages or disadvantages. And this is the basic dialogue, and this is what we hear and what we read in blogs and the internet. And the truth is there's much more into that. Okay, even if you're going to be allocating a certain amount of money or a certain amount of percentage of your account in a single trade, you can allocate your risk differently in each situation. Okay. And before we go to the model, there's sometimes when setup, there's an argument for allocating more money into that setup, and there's arguments for allocating less money in other setups. Okay, each one of us knows a strategy. Each one of us has a we saw a YouTube video, or we paid for an academy or whatever, and we have a strategy, a trading strategy. And that trading strategy works better in some scenarios, in some situations, works worse in other situations, correct? So if we're using a trending market strategy, maybe our strategy will work more poorly in a ranging market, in a sideways market. And if we're using a ranging strategy, it won't work well on a trending market, correct? So each one of our strategies has different setups, high quality setups and low quality setups. So there's no sense of allocating or risking the same amount of either money or either percentage of our account in both high quality setups and low quality setups. If we are taking, for example, a counter trend trade, we shouldn't be taking the same amount of money or risk in that trade than if we're trading, if we're taking a trade in the direction of the trade, which has a higher potential of profit or higher win rate. So our strategy itself has different scenarios and different setups that we need to know differently. So we need to know it, we need to learn our strategy and know it, what are the high quality setups and the low quality setups inside the strategy. And once we know our statistics of our strategy, the different scenarios, possible scenarios, now we divide it into high quality and low quality ones. And we want to risk more on the high quality setups, the scenarios, and we want to risk less on the low quality scenarios. Okay, if that makes sense. Let's move a little bit deeper. Okay, so there's two important concepts that we need to know, which is the scale in and scale out. And most of us, we know the scaling and scale out techniques of a trade management when we are on a winning situation. When we're on a winning situation, we know we should or we can scale in. Okay, we can add to a winning situation in order to maximize our profits. Correct? That's very obvious. And we also know this scenario right here, that we can scale out, we can reduce part of our position when we are on a winning situation. Why we do that? Because we can reduce risk. We are maybe in a full position into a winning trade, and we can maybe half profit, or we can take profits or cut half of the position and let the other half of the trade running in our favor, correct? So we have now minimized risk from the trade. So these two scenarios, okay, scaling out of a winning trade and scaling into a winning trade, we know them. But the truth is, we, or most of us, we are not very familiar, or we haven't practiced the scaling and scale out scenarios when we are on losing situations, in losing trades. And actually, when we manage to master these techniques of adding into a losing position or reducing, scaling out of a losing position, we can make wonders into our strategy. Because let's just imagine we have a certain strategy, and we know our win rate on that strategy is 60%. Okay, win rates, meaning 60% of the times our strategy wins, and 40% of the times our strategy fails. Okay, loses money. So what if using these techniques, okay, adding into a losing position or reducing, scaling out of a losing position, we can fix, or we can reduce the risk on the losing side of the trades in half of the times. Okay, so half of the 40% of the time our strategy fails, we manage to break even on that losing trade, or we manage to fix that trade. Okay, so now we have brought our strategy from a 60% win rate to an 80% win rate, because now 40% or half percent of the 40%, half of the time the 40%, we can now break even on our losing side. So now we're only left with a 20% lose rate, okay, or lose ratio in our strategy. So I know it sounds counterintuitive, and not a lot of people talk about these topics, adding into a losing position or scaling out of a losing position, but I wanna talk to you about these topics and practice them, of course, before going live with these techniques. And you will see we can do a lot of good stuff with this technique. So let's discuss these ones deeper. And I want to show you the risk allocation model. Okay, the risk allocation model, it looks like a triangle. Okay, like a pyramid, where you add and reduce to your position and to your lot size, and it ends up, or in my mind, it looks like a triangle. Okay, so let's start with the winning positions, which are the ones we know, and they're more we know them. So let's say we buy here. Okay, we buy at this line right here, and our position is going in our favor. Correct. So it starts going up in our favor. And at some point, we want to buy again. We want to add to that position because we want to maximize our profit. Correct. That's the whole idea or whole goal of adding into a winning position. We want to maximize profits. So our buying position, our buying setup starts here, and once we add, our position grows. Okay, so it forms like a triangle, which the top part of the triangle is bigger, it's larger than the bottom one, because at this level right here, we added, okay, we bought a new position. So now we have more lot size, more allocation towards our objective, our take profit. Now, when we reduce on a winning position, okay, this is very similar. A lot of people is familiar with this. Okay, we buy at this level right here with a lot of, with our full position, let's say 0.5% or 1% or whatever percent of your account you allocate at this level right here. And then once the trade is going in your favor, I want to take this one, okay? Once the trade is going in your favor, you actually cut it, correct? You peel off your win, you take partial profits. So at that point, now your position is smaller, okay? So you leave less of your position going up towards your take profit, okay, in your favor. So this is something that most of you know. And now I want to go to the losing side to see the advantages of adding and reducing in a visual way of doing that. So why would we add to a losing position? Okay, let's say we have a buying position right here at the top, and the buying position starts going in our favor. And our stop loss is all the way right here. And we add another position right here, okay, from another buying position. It sounds counterintuitive and sounds like this is something that we should not be doing. But in fact, if there's a reason behind doing this, if there's a reason and a justification of buying at this certain level, and from this point the trade starts going in our favor, okay, now we have a better entry point at this point that goes in our favor, correct? And of course, if this goes all the way down, so we have a larger loss, okay, looks like a larger loss down here, but again, adding to this position should not be larger. We shouldn't be risking more than the initial risk we were ready to take. So we shouldn't go beyond our 0.5% or 1% or a certain amount of dollars if all of these trades reach the take profit, the stop loss, correct? But so if we buy here and then we buy here and this goes in our favor, now we have a better entry point and we have actually fixed this upper position right here. Of course, there's a chance that this both position goes in our against us and reach take profit, the stop loss. Okay, it's something we will not know that until after the fact. Okay, but once we are in the real market and with real situation, there has to be a reason why adding into this point right here. So that could either take us into the trade in a better entry point, and or it can help us to fix this first entry that was a bad entry, for example. Okay, and reducing on the on the losing side, okay, we buy here, and then the market, the trade starts going against us, and we decide to cut that trade, okay? So the opposite of peeling off a winning position, now we're going to peel off the losing position. So instead of all this money, okay, this large trade going all the way to the stop loss, now we have cut that and we have left a little less of the trade, or less of the position going to the stop loss. So for example, if we were risking from here to here, let's say 100 pips or $100 or whatever, and we decide here to take half of the losses, so this second half will save us money that we can reallocate afterwards in a new position. Okay, so let me give you an example, and we will jump soon to the charts, and I'll give you some examples. Okay, all of you who have been following us for a while, you know we are big believers of institutional trading and supply and demand zones, and price action. And if you recognize this is called a demand area. Okay, this is how it looks, a classic demand area, where you have a sideways movement, balance between buyers and sellers, and for some reason there's a big breakout of that movement right there. So the way of trading a demand area right like this is waiting for price to pull back and come back to these areas right here, okay, to that zone, to the demand zone, and then wait for price to come to this area, and then a continuation, okay, a rejection. And all of you who trade demand and supply zones, you know you have three potential entry points. The first potential entry point is the breakout line, okay, the moment where the zone, the balance zone, was broken. Okay, so it could be that level. The other potential entry point, okay, with a buy limit order, it's called a decision zone, a decision point or decision level, which is the moment where that candlestick started. Okay, so that would be there. It's usually at the middle of the zone, of the demand zone. And the third possible entry point would be the bottom of the demand area. For all of them, our stop losses should be at the same point, okay, below the demand area. Once the demand area is broken, we should be out of the trade. We shouldn't be holding those buying positions longer. And the dilemma now, the question we all have always is, where do I get into the trade? Do I get in here? Do I get in here? Or do I get in here? Each of those has different advantages and disadvantages. For example, if I place a buy stop order here, I have larger chance, okay, bigger chance to get into the trade, to get triggered, but my distance to my stop loss is larger than these ones here. And in the opposite, if I only take a buy stop here at the bottom part of the demand, so of course the distance to my stop loss is smaller, so I can make it into a better, a better risk reward position, but I have less chances of getting triggered. Correct? Sometimes the price will come and take this, test this level or these levels, and then will reverse, and I might miss the entry. So why, instead of allocating our money in only one of these levels, okay, instead of risking 1% here or 1% here or 1% here, and I'm saying 1% just as an example, that's something you have to know for yourself better, and maybe you risk 2% or 0.5% or whatever, but just instead of allocating our full risk in a single entry point, we apply our triangle method. So I apply or I set a 0.25 risk here, a 0.25% here, and 0.50 at the bottom. Okay, now what have I just done by doing this? If the prices, it's something we need to explain live. Okay, with new information, you can make decisions in real time, correct? But let's say prices come to this area right here, touches my first entry point, and then goes in my favor. That's fine. Okay, I can now wait for a pullback and add the rest of my position to maximize my profit. Okay, then I have to scale into a winning position. But if I get triggered into this one and price goes lower, okay, in a sense, I'm adding into a losing position, correct? Because I'm holding this buying order here into drawdown, into a losing position. But this one here, that's also a valid entry point. So there's no reason why I shouldn't be getting in also at this point here. But I have to be careful, just not over leveraging my account, not over allocating. That's why I start small, okay, as the pyramid, and then I add another position here. And now if this position goes in my favor, so now I have a 0.5% going in my favor, or I can maybe close this one right here and only stay with this position right here. And if price goes against me, triggers me in here, triggers me here, and triggers me in here, and then reverses, then bounces in my favor. So now I have my full 1% in my favor. And if it goes against me, well, it doesn't matter, okay? I'm only exposing 1% of my account, which I could have done that. I'm taking like a shotgun approach instead of a sniper approach. So I'm giving the market and myself more flexibility where to get in and get out. Questions getting into the chat. So I'll go in a moment to review the questions. So and now I would like to go to the platform and show you some live examples. So just give me 1 second. Okay, so please tell me if you can see my my trading platform. Yeah, great. Okay, now I'll give more examples, and I think it will be clearer. Okay, so this is the 1 hour chart on the USD franc, and you can apply this really to any time frame and all all assets. I just have some demand areas here, and you can apply this again. You can apply this to all your strategies. Okay, I'll give you examples with demand and supplies, but maybe I will bring some random strategies and I will give an example with them. So we have some demand areas here in the chart. Okay, I see these 2 demand areas. So usually the way to trade demand areas, I told you, is placing a buy limit at the breaking point, a buy limit at the decision point, and a buy limit at the bottom part of the demand area, or waiting for price to come into this area and then be in front of the charts and taking the trade manually. But if you want to just set and forget, you can place buy limit orders. Same here, we could place a buy limit on the breaking point, a buy limit on the decision point, and a buy limit on the bottom part of the demand areas. For all these positions, the stop loss needs to be below the demand area, maybe there, or maybe below this pivot here. Okay, so it doesn't matter where I place the entry point, the exit point is always the same. Okay, so all my exits needs to be here, no matter, it doesn't matter if I get in here or here or here, I need to get out there. Okay, that's the last, that's the stop loss level. So now I need to do, you know, some number. I need to run some numbers. I need to measure. Okay, I have from here to here, I have 35 pips. And from here to here, I have 27 pips. And from here to here, I have 16 pips. So let's say I want to risk, on this account, I want to risk $100, okay? So instead of placing here a buy limit, risking the $100, the complete $100, I will place here let me switch that. I'll just text it here. Okay, that first entry will be risking $34. Okay, that one right there. The second one will risk another 34. Reduce the size. I'll do this 24. And the last one will be a $42 risk. Okay. Now, if all these trades fail and 1, 2, 3 entry points take profits, I will lose the $100. Okay, that I was willing to risk at the beginning. So instead of risking here at the top the $100 and then missing these entry points, or the opposite, just leaving only this bottom position on with $100, I will use the pyramid method. Where I risk a little bit here, and a bit more at the bottom, okay? And if all of that fails, then I'll get out losing $100, okay? Now, allocate that or adapt that. If you're, you know, if you're trading Forex, so that would be in lot size. If you're trading stocks, that would be a certain amount of contracts. So you will have to do your tuning and adapting to your own strategy. Okay, so you can see the logic behind. Now let me see. Okay, there's a lot of questions. I'll go to the chat. And now what happens? Let's do this exercise together. Okay, what happens if price goes down, triggers me in only in this position, and then bounces? Okay, how do I overcome the fact that I have left pending orders here and that weren't triggered? Now I have a small position going in my favor, and I want to maximize my profits, correct? So now I need to inverse the triangle. I need to build my opposite triangle, and I need to wait for an opportunity to add into my winning position. If that trade goes in my favor, maybe I can wait for a confirmation pattern or whatever. I can wait for a pullback, and then an opportunity to add, okay, the rest of the money to that position, to that winning position. Okay, now I've made a an inverse triangle. Okay, now I'm adding into a winning position. Okay, so I hope these guys this makes sense. Let me go to the chat and see some questions, and I'll look another example, or maybe a different strategy to give you an example. Just wait a second with me, please. Some profitable regularity, a true personal strategy, using more tools, some release points. Thank you. Okay, thank you. Thanks for the compliments, guys. All good. All good. Okay, let me go into a the equity show on chart and adding into a winning trade. Okay, let's doing like in live. I would have to go to to lower time frames, maybe to the 1 minute chart, and hoping for that to happen. But let's just imagine we bought, okay. No, let's imagine we got into a buying position here that went into our favor. Now it has pulled back, and we identify there's a new consolidation or whatever, okay? And then we can add to this position, which is in our favor, we can add new money or new trades in order to catch the next run, okay? Because we know there was a breakout and then the pullback to the breaking zone, and maybe demand has become now, resistance has become now support or whatever. Okay, this is just an example and a back testing example. And then here you add to catch the next leg. Okay, the next leg run here starts moving in a sideways movement. Okay, now this is a rally, and now it's spacing, it's consolidating, and then this might break either to the lower side or to the higher side, and you can place a buy stop right there, and that movement triggers you in, okay, to the upside. So now from this initial position or this initial position, after a consolidation, you add into in the same direction you are on a winning trade. Okay. For all of you guys that are part of the 5ers and you trade with us and you come to the trading rooms, you can see us using these techniques very frequently. I use this a lot. Trying to think of, okay, let me give you another example. This is the Euro USD on the daily, okay? The Euro USD has formed now a reverse or inverse head and shoulders. You can see the left shoulder, the head, the right shoulder, and and the neckline somewhere there. So in real time, and a lot of people were doing this, a lot of people were anticipating this kind of formation, and we're adding position, we're buying right here. And that movement went in their favor, but actually the break of the neckline, correct, this is a classic head and shoulders trade, that level right there, it's another valid entry point. So either if you're holding these buying positions here, and you are in profit right here, there's nothing from holding you or keeping you from adding new buying positions at the break of the neckline. And this candlestick right here would be triggering you into a winning position on top of these winning positions you were holding already. Okay, that would be another example. Where I put my take profits, yeah, the take profit has to be depends on your strategy, correct? This is only risk management techniques or trade management or risk allocation techniques. But if this is if you're trading the these head and shoulders right here. So your stop loss, you know, they need to be here, and maybe you can trail them to the right shoulder, and your take profits, same. They should be either here, or you can maybe leave them run if you think there will be a break. Okay, if the context tells you there will be a break of those highs, so you can maybe leave them running. Or you can play with the different methods. Okay, let's say you're in a winning position here and winning position here, and now you find that price come all the way here. Now you can maybe reduce, okay, scale out of a winning position. If you're in profits here and here, once it reaches your first take profit here, now you can maybe take profits from this one, letting this or letting the remaining position breaking, okay, to see if this breaks to the upside. Okay, so it's not like you have to do one technique every time, all the time. You can play with them and mix them with every new information you receive from the markets. Have I backtested this method and found it more profitable than a static 1% entry model? Yeah, for sure. We all know the static 1%, okay? And I was speaking 1%, but it could be 0.5% or 2% or whatever, correct? We all know that principle, okay? The fixed risk allocation, and we all know strategies, or we were taught strategies that they should be meeting a high win rate or a high risk reward ratio. So if that was that simple, everyone would be making money, correct? Of course, there's the psychological part of trading or whatever, but all strategies have the potential to give you high statistics or good statistics. The reality is, when you maximize into trading profits and when you scale out from losing positions, you make your statistics even better. Okay, there's no reason. For example, if you see, I will clean this. Okay, let's say I was short here. I entered a short position. My stop is right there. After a movement like this, that sharply against me, I'm now in a losing position. There's no reason why not to cut part of the losing trade. Okay, we are always very nervous and very anxious about cutting our winners, okay, to secure profits and to reduce risk and to try to let our winning trades run for longer in our favor. And we're never willing to do the opposite, which is cutting our losses. So instead of losing a whole 1% from here to here, I will cut that, okay? I will take partial profits right there or at some point. And now, instead of losing a whole 1%, maybe I will lose 0.70% or 0.75%. So now I have saved 0.25 or 0.3 of my money, of my account, to allocate that in a new and a better setup, okay, a quality setup. Chris, that's for you. So yes, I find these, active managing techniques to be very, very profitable. Okay, especially the cutting your losses, okay, taking partial losses and adding into winning trades. How do you know if you should be scaling in or scaling out of a position? Okay, for me, it's like a map. Okay, I'm into a trade. Now the trade can either go in my favor or against me, correct? A losing position or a winning position. And depending on how the market is forming or how aggressively it's going in my favor or new information, with every new information, I have to make the decision if either to do nothing, to scale in, to scale out. Okay, it's something I cannot tell you right now what to do every time. Okay, it's something you have to decide on every single setup and depending how the market is moving. So if the market is moving very, very aggressively in your favor, so you want to take advantage of that movement in your favor. If the market is moving very aggressively against you, so you want to cut that loss, correct? You don't want to hold that loss for longer. So you want to maybe consider scaling out of the losing trade. If the market goes against you, but very slowly, maybe giving you, it might reverse in your favor. So you might consider now adding into that losing trade. If you're in a drawdown, you can add to that position because you identify and you have signals in the market that will eventually go in your favor. Okay, that your setup is still valid. So that would be the answer. Guys, we're getting to the end of the time. Just let me show you one last thing. If you have any question, guys, don't hesitate to send us an email to the support team, help@the5ers.com, and I invite you to visit the website. Especially if you trade Forex, go to our website and join us. We trade Forex here, and we're a fund. We want to welcome traders to take part of the fund and manage it and grow it. You can keep part of the profits, and the fund grows with you, and you grow with the fund. And besides, in addition to the account, the funded account you will get once you join us, look at the huge amount of resources we have available for you. So you will get trade ideas. A lot of good traders will post their ideas here, and you can post yours, and you can get feedback and interact with the traders. So you can get some signals from here, and we have trading rooms every day, 3 times a week. We hold live trading rooms with our traders. So we chat with them and we trade live with them. We have videos and courses, and you get all these once you join us and trade part of the fund. Okay, guys. So thank you very much, guys. Thanks for joining. Any questions, just send us an email. We'll try to be in touch with you. Thank you, guys, and have a nice day.